I'm standing by with Marc Lipschultz, who, of course, is the co-CEO of Blue Owl, focuses heavily on private markets. But, of course, you're a publicly traded firm and have seen significant appreciation this year in the markets. When you think about the path forward, is it really going to be tried and true vanilla private credit that's driving the growth from Blue Owl? Or is it going to be something else, given that you've made so many acquisitions in spaces outside of traditional direct lending?
So for Blue Owl, and always a treat to be here with you, for Blue Owl, I think three words I would focus on. There is scaling, there is innovation, and there's diversification. And those three together, I think, are the kind of words I'd keep in mind when I think about the future of Blue Owl. Take direct lending. It is a fantastic business. We're one of the market leaders. We've been able to deliver outstanding results for our investors, our LPs, which ultimately is the customer base. And as a result, that's going to continue to be a great business, but that's about incumbents and leading with scale, and we're fortunately one of those people. That's a great business for us. But when you look forward, backward, that was a great place. 10 years ago, we identified that opportunity. 10 years ago, we identified private wealth as a channel. That's become a huge opportunity. People almost looked at us cross-eyed when we started that 10 years ago. So thankfully, we've established great positions there. That's about continuing to scale. Diversification, as you said, we've added products organically and inorganically by acquisition. And then innovation, to me, is really the tag word that matters most, which is it's about going where the markets are going next. Private credit, it's not that the story has been told, but we know what the story is. What's new and next and important for our shareholders and our investors is the alternative credit business. That is to say, asset-backed credit. It's data centers and the digital economy, digital infrastructure. That's where we're going next. That's where the innovation is really going to come from, and the next leg of really, I think, very attractive growth.
You know, now that you are integrating these acquisitions, what are the numbers to support that growth? I know that you and I have talked about asset-backed finance, for example, and that by definition the growth rate would be faster. So what do these growth rates look like in these businesses outside of direct lending?
So, you know, I'll use this by kind of template or example. Think about the real estate business we acquired, Oak Street. Market leader in triple net lease. Here's a business where already we have, since acquisition, our latest fund doubled in scale from the prior one. That's already largely committed. We'll be back in market next year with the next vintage of that product. Oak Street has tripled as a part of Blue Owl just in the last few years. And very importantly, through a tumultuous time in the generic word real estate, has delivered outstanding results and is perfectly positioned for, again, let's talk forward-looking, onshoring. Digital infrastructure, again, in sort of the form we've done today with people like Oracle, where we've been able to build data centers, data complexes, and own the buildings, the physical buildings, like we have done as market leader in Oak Street. That's a perfect template for where we're going with things like the acquisition of Atalaya. We've got it fully integrated. We have a great integrated operation between now our asset-backed credit and our direct lending credit. And what that means is we can originate, share ideas, share opportunities, and do in asset-backed credit what we did over the last 10 years in direct lending, which is, we believe, become one of the market leaders in that case in probably a $7 trillion addressable market.
When you think about the private credit world right now, there's a new player in town in a much bigger way now with BlackRock's acquisition of HPS. What does that mean to you to have, HPS has been around, but BlackRock now also is a new competitor?
So, I'm big on, actions speak louder than words, and I have a ton of respect for BlackRock. So what do I take from it? BlackRock has likewise, I think, come to acknowledge, grasp, be enthusiastic about the fact that private markets are a critical part of the future. It's where the growth is going to be. And again, I always get back to the why. The why is because the private market solutions for the end investor, they work. It doesn't mean every solution by every manager at every moment, but it means the right solutions done by the right managers deliver great risk return for the investor. And so I think BlackRock is, by its actions, as the biggest in the world, saying, hey, listen, the public market, great, it'll always be part of an important capital market ecosystem. But the private markets writ large are the future.
Is there a point at which the space is too crowded?
One can imagine such a moment, and I think we're actually seeing it in parts of the overall ecosystem. I think it's safe to say there will be fewer private equity firms 5 years from now than there are today. There's an over-proliferation. But that's been 40 years, 50 years in the making. So, when I look at markets like direct lending, they're still very young by the measure of evolution of the opportunity, market share, innovation, and certainly places like asset-backed finance are nascent. Hyperscale data centers, like IPI, the market leader without a question in helping investors access this very, very interesting infrastructure-like way to play the digital economy and AI. Those are new. So they're kind of the opposite of crowded. They're pioneering spaces, and I get very excited about that. So I actually don't think crowding is the concern of the time.
So what about the competition? We always talk about this, the banks versus the non-banks, right? You have seen leverage finance markets way open now. What does that mean in terms of the M&A comeback that investors are expected and the role that you and your rivals have in it?
Yeah, the active role of the syndicated or liquid bank markets is a bit of a double-edged sword, right? Which is to say, look, in 2021, the markets were wide open, and that was one of our busiest times. In 2022 and 2023, they were entirely closed, and that was a wonderful time for probably a different reason, right? Which is there was kind of no alternative choice for someone that wanted to act. Probably a bit like, the three bears, somewhere in between is pretty good, actually, right? We want there to be a vibrant market that catalyzes activity. The biggest negative, if I think about what was a terrific year in 2024, but when I look at 2025, and frankly, I have even more optimism, the biggest missing piece was just volume of activity. People just weren't doing enough. Too many uncertainties around interest rates, uncertainties around politics, therefore, or related to, an inactive syndicated market. We need those markets so people feel the confidence to go do the M&A, to go do the transaction. So I feel like the setup in 2025, and we've always said this, we welcome a vibrant liquid market and illiquid market. And sure, when markets are fully closed, our spreads are a bit higher. When markets are fully open, our spreads are a bit lower. But our businesses deliver a meaningful premium and a great risk return in any of those markets. And that's working.
You mentioned interest rates is part of the consideration here as well. And there's a lot of question about what they might look like in 2025, particularly in light of the tariff policies put forward by the president-elect. Do those policies concern you at all? Do you think that inflation could be stickier than a lot of people are accounting for right now?
So you and I recall, talked about this probably over the last year and a half. We have had a view that remains our view today, that higher for longer is the path forward. And I say that partly just anchored in this historical reality. The rates we're talking about today are not atypical. Zero is atypical. Now, I'm not predicting a specific rate path, and I imagine they'll moderate some over time, but we've already experienced something. This time last year, people were talking about 7 rate cuts. And we said, we don't see it, we don't understand it, we don't see it, because the inflationary pressures are still there. And frankly, in a strong economy, and I think we have the good prospects for a strong economy in 2025, and as you said, adding trade considerations and other geopolitical dynamics, there's a lot of reason to frankly think rates stay, relatively speaking, higher. Candidly, no surprise, in a floating rate business, we're okay with that result.
And really quickly here, we only have about 30 seconds left, but if you had to call how many rate cuts, I never ask you this, but if you think rates are higher for longer, how many times do you think the Fed can cut through the end of next year?
So I have to acknowledge the beauty of my business, and perhaps it's my own ignorance, but I don't know the number of rate cuts. I'm confident I don't know. If I knew, there'd be a much easier way to execute this business. We have 1,000 people so we can deliver the results we do. If I knew the path of rates, I'd have a better way. But I can tell you this, being in a senior secured floating rate business, which we are, I'm there because I don't have to make that determination.